Hello students, welcome to my class. This is Professor Vicente Saya and this is the presentation of part 1 of chapter 20, Accounting for Pensions and Post-Retirement Benefits. So two issues. So we are going to talk about the recognition or the how to record pensions and post-retirement benefits. Now, the first objective, first of all, let's back up. This chapter is divided into 4 sessions. Number 1, we are going to talk about the nature of pension plans. Number 2, we are going to talk about accounting for pensions. Number 3, we are going to talk about using a pension worksheet and also talk about reporting pension plans in financial statements. So those are the 4 sessions of the chapter. So let's take a look at the first objective. We are going to make a distinction between accounting for the employer's pension plan and accounting for the pension fund. What do we mean by that? These are 2 separate issues. The first issue is accounting for the employer's pension plan. So we are going to deal with how to the accounting treatment of pension plan of the company that is sponsoring the pension plan. Now, so that is the first issue. The second issue is accounting for the pension fund. That is not the focus of this chapter. The first issue is the main focus of this chapter. Now, I'm going to talk more about that in a minute. So, let's take a look at the nature of pension plans. We've said here it is an arrangement whereby an employer provides benefits to retired employees for services they provided in their working years. In other words, this is the benefit employees will receive from the company that they work for or from their employer when they retire. And that benefit results from the number of years that they put in working for the employer. So, take a look at this diagram. We have 3 parties involved in this arrangement. Number 1, the employer, the company. Number 2, the pension plan administrator. Most of them will be banks. That is the entity that is responsible for receiving the pension contributions from the company, and they are also responsible for making payments to the retirees in due course. So that is the second party to this arrangement. And of course, the third party are the people that retire, the retirees. So the employer or the company makes X amount of contribution to the pension plan administrator. It could be a bank. And the bank will be responsible for the investment of the funds and administering the fund. In due course, the administrator would now make payment, like we indicated earlier, to the retired employees. So like we said earlier, listen to this very carefully. Our focus is the accounting treatment or the accounting recognition of pension from the standpoint of the employer, not from the standpoint of the pension plan administrator. The accounting for the pension plan administrator is not the focus of this chapter and is beyond the scope of this chapter. So moving along, let's take a look at the different types of pension plans. Number 1, we have what we call contributory plan. That is a situation whereby the employees voluntarily make payments to increase their benefits. So in addition to the company making payment, voluntarily you also make additional payment. So we call that contributory plan. Non-contributory plan is a situation whereby the company or the employer make all the payments. And number 3, here they call it the qualified pension plans. You know, uh, qualified pension plans basically offer tax benefit. What that simply means that the company or the employer is able to write off the pension contributions on his tax returns. We also have another type that is called unqualified pension plan. They did not talk about that in this textbook. Unqualified pension plan is a plan that you put together for some employees of the company. We call it unqualified because you are not able to write off the company's contributions on your tax returns. And one of the reasons why you cannot do that is unqualified pension plans discriminate against some employees, and the federal government doesn't want that. So the only one that you can actually write off are the qualified pension plans. So I really don't like the arrangement of this bullet because the qualified pension plan could be contributory or non-contributory. Now, moving along, it is also important for you to know here that the pension fund should be a separate legal and accounting entity. What does that mean? In other words, the pension fund that is being administered by the pension plan administrator is a separate legal and accounting entity of itself. So like I indicated earlier, that is one of the reasons why we are not dealing with the accounting treatment from that standpoint. Again, our main focus is for the accounting treatment from the standpoint of the employer. Moving along, at the bottom of this slide, here we have here some samples of very popular companies that have a pension plan, and here we are talking about the percentage of their pre-tax income that constitute a pension. Well, that is not a big deal. Take a look at the bottom of this slide. We said the two most important, the two most common types of pension plans are what we call defined contribution plans and defined benefit plans. All right. Now, the key word is defined contribution plans, defined benefit plans. So we are going to talk more about these two in subsequent slides. So the next objective is we are going to identify types of pension plans and their characteristics. So moving along, so let's take a look at these two types of plans. We have the defined contribution plans and we have the defined benefit plan. Listen to this very carefully. The defined contribution plan simply means the plan defines specifically what the employer is going to contribute into the plan. So the employer will say, well, we contribute 2% of your salary into your pension account, and that is basically it. So the contribution is specifically defined. Now let's take a look at the second one. That is a defined benefit plan. That is a plan whereby the company defines the benefit that you are going to receive when you retire. So for example, like in the city of Chicago, state of Illinois, their pension plan is considered as defined benefit plan. And they will say if you work for the state for 25 or 30 years, you receive 25% of your salary for the rest of your life, with 2-3% increase every year for the rest of your life. So your benefit is specifically defined. Now let's take a look at the first one, defined contribution plan. That, an example of that would be 401k. If you work for a company and they promise to pay 2% of your salary into your 401k, they are going to do that all day long, all year long. If you work for 30 years, that is fine. At the end of 30 years, you retire. Whatever is available in your account based on the performance of that particular portfolio is what you are entitled to. So the company doesn't really care after that point. So the defined contribution plan, the risk is very minimal. The risk is only to the extent of what they said the company is going to contribute in your plan, in contrast with the defined benefit plan. So let's take a look at some of the bullets here. The first one, employer contribution determined by plan. Risk borne by the employees, so if the money is not enough by the time you retire, it's up to you. The benefits are based on plan value. Whatever is the value of that plan is, it is what it is. Take a look at the defined benefit plan. The benefit determined by the plan. So the benefit is predetermined. Employer contribution varies depending on what the actuaries calculate, and the risk obviously is borne by the employer. Now, how do we know how much the company is going to contribute, or the entity or your employer is going to contribute into that plan? Look at the bottom of this slide here. It said actuaries make predictions called actuary assumptions of mortality. So they take into consideration the average age that people die, the average employee turnover, the interest, how much you are going to earn in the plan. They take a lot of stuff into consideration to come up with how much is needed for the plan. So let's take a look at the third objective. We are going to talk about the measures for valuing a pension plan obligation. So let's take a look at two questions that are very critical here. Number one, what is the pension obligation that the company should report in the financial statement? And what is the pension expense for the period? The pension obligation that the company should report in the financial statement, the balance sheet, and the pension expense for the period, that is the income statement. So those are the two important questions. Now, how do we calculate, or how do we measure the liability of the pension? Let's take a look at what we have here. The employer's pension obligation is the deferred compensation obligation. It has to his employees for their service under the terms of the pension plan. Now, what does that mean? First of all, we need to talk about some key terms here before we have a good understanding of this. At this point in time, let us go ahead and cut off here so that we can start part 2 of this presentation from this point.